Well, it's good to see you again. Thank you for investing your time watching this video. I want to talk to you about expenses on investment property. And as we move closer to tax time, it becomes very, very important. If you are a salaried employee and you do your tax at the end of the year, all you're really concerned about is your income, pretty much. You've got some preset expenses you're allowed and you apply them, but it's pretty easy to do your own income tax. When you're an investor, it gets a little more complicated. And what gets complicated about it is the expenses, the money that you spend on your property. And all those expenses can be applied against your income, but they're applied in different ways. What I want to raise to begin with is the importance of record keeping. It's vitally important to keep good records. And not just financial records, although we're going to sort of zero down on financial records. I'm in real estate and I drive a car and I use the car for my business, and I keep a book in my car and I track all my expenses. If I get some gas, it goes in, I put down the mileage and the amount of money I spend, how much gas and so on. Every time I do repair and maintenance on the vehicle, it goes in that logbook. And it's very, very handy, and you want to do the same thing with your rental properties. If it's a car, as an example, I get in my car and it starts making a squealing noise when I put on the brakes. I think, oh, I need a brake job. I can go back in the book and find out when was the last time I had brakes done. And is it reasonable that I'm going to be needing a new brake job or not? And it's exactly the same thing with your rental properties. Let's suppose you have a tenant moves out, you go into the unit, and it really needs to be repainted. It's been a while since it's been repainted. There's scuff marks, there's a lot of holes where they've hung pictures and so on. So you paint the whole unit. All right, a year and a half later, that tenant that you rented it to moves out, you go back in, and there's some damage done, nothing terrible, but there's, again, more nicks and gouges in the walls from furniture being moved around and holes in the wall where they've hung pictures and so on. And now you've got a problem. Do you want to repaint the room? Do you want to repaint the entire apartment? Or do you want to touch up the scuff marks? If you can go back to your record keeping and you've got, when you painted it last, the type and make of paint, you can look it up and you can probably get away touching it up and look as good as new. Otherwise, you're going to have to repaint the whole unit. So it's handy to have that. Also, for example, appliances. Tenant calls you up and says, my fridge isn't working, or it's leaking in the floor, and you can call a repairman, but you look it up and you find out the fridge, it's been 15 years in that unit. Well, maybe it's time, rather than spending more money cobbling it back together, maybe it makes sense to replace it. If you have, as my plan is suggesting, at least 10 units as you go along through this program, and they're a mixture of duplex, triplexes, and singles, you may have 15 or 16 rentable units. You're going to forget what paint color you used. You're going to forget when you put the appliances in. And so record keeping is absolutely important. But it's also important with financial record keeping. You see, every time you spend money on repair, on maintenance, or on upgrades, you get a tax break. All those expenses can be applied on your income tax to reduce your taxable income. But they're not all applied exactly the same way. Yes, they will allow you to spend the money as before tax dollars rather than after tax dollars. Huge benefit. But there's two approaches to it. Any given amount of money that you spend can either be expensed or it can be capitalized. And there's a big difference. With an expense, you write it off dollar for dollar, the total amount. If it's capitalized, you depreciate it. And so you can only, in any given year, apply a certain small amount against your income tax for that year. Let me give you a simple example. Let's suppose you bought a property for $500,000. All right, you're allowed to depreciate that property on an annual basis at a rate of 4%, but you can't depreciate the whole thing. You've got to separate the improvements, which is the bricks and mortar, from the land. And it's usually 25%, 75%. So 25% of the cost, or $125,000, is land cost. You can't depreciate that. So your asset or improvement cost is $375,000, and annually you can depreciate it at 4%. Well, that means you can depreciate $15,000 the first year, and it shows as though the value of your property is going down. Now, it actually isn't. We know property continues to go up, but you're allowed to pretend it goes down for tax purposes. We call that depreciation, 4%, on a $375,000 base figure. Well, let's suppose you spend $50,000 on repair and maintenance. Well, if you can expense it, you can take your taxable income and you can subtract $50,000 right off the amount of money that you earn from your investment income. If, on the other hand, you're capitalizing it, you can add that to your capital base, so your $375,000 goes up to $425,000, but the actual $50,000, the only amount of benefit you're getting that year is that 4% against it, so that's $2,000. So if you expense it, it's $50,000 this year. If you capitalize it, it's $2,000 this year. Of course, if you capitalize it, you get that benefit year after year after year, and a depreciating balance each year. Very small amount, but it reoccurs. Here's a rule of thumb, because you may say, well, Wayne, I would obviously want to expense everything, not capitalize everything. It's hard to know, because when you capitalize it, you're also going to have to recapture if you ever sell the property. Mind you, if you follow the Money Machine seminar, you're never going to sell it. But if you can expense it, you can get away with paying less tax this year. And the rule of thumb that seems to work, it's not cast in stone, but the rule of thumb is if you're replacing something, you can expense it. If you're adding a new component, you need to capitalize it. So your furnace blows up and you have to replace the furnace. Well, that's expense. If your property needs to be repainted or the carpet needs to be replaced, you're doing something that's already there, and so you're replacing something, I would expense it. But you decide you're going to add air conditioning, and so you put in an air conditioning unit. There wasn't one there before, so that's capitalizing. You are going to put a deck in the back. There wasn't a deck before. That's a capital cost, not an expense. Now, it can be argued, well, the example of the deck or the furnace, well, you're depreciating it year by year by year originally, and so you just add it to your capital cost. I think you can be a little more aggressive than that. But when it comes to some of these gray areas where you're not just sure, obviously if it's a small item that you've done, it's pretty clear cut. But some of these other areas that are gray, you want to talk to an accountant about it, because it gets a little cloudy. But either way, capitalize it or expense it. Either way, it gives you a break on your income tax. And in order to realize that break, you need to keep good records, and especially if you are capitalizing it and depreciating it, you need to keep accurate records of what you've done year by year by year so that you don't go off the rails. Hope that makes sense. I want to thank you very much for joining me on this video. I'll talk to you again next week.